If you live in Europe and you're thinking about stock investing, this video will put you ahead of 90% of other investors. Back when I was the CEO of a European investment company, I earned many millions of euros from my clients. Now I've packed my 17 years of experience into the ultimate guide to stock investing for beginners in Europe. By the end of this video, you will know a proven stock investing strategy which takes only 3 hours per year and, according to evidence that I will show you, gets better results than up to 90% of professional investors. And the first thing that we need to understand is, why are stocks such a fantastic investment? Maybe you've heard that if you put $5,000 in Nvidia stock 10 years ago, today that would be worth over $1 million. Or you may have heard about regular investors like Robert Morin, the librarian who invested in stocks and built up wealth of $4 million. Where does all this profit come from, and why do most experts recommend stocks as the foundation of your portfolio? I remember struggling with this 17 years ago as a young banker on Wall Street. For the first time in my life, I had money to invest. But I came from a poor family in Eastern Europe where nobody knew anything about investing. So at the start of my career, different kinds of investments, stocks and bonds and gold and currencies, they were all the same to me. In fact, to me, investing seemed a bit like gambling. Maybe you win, maybe you lose. Fortunately, I had a good mentor at that time, an older colleague at UBS Investment Bank where I worked, and he asked me a simple question. Tom, what creates wealth in this world? I asked him, what do you mean? And he said, well, go out on the street, look at all the buildings, all the cars, all the clothes that people wear. Who created all those things? And, I was new on Wall Street, but I could guess what he meant. I said, it's companies, right? He said, that's right. Companies make goods or services, they earn money, and they create wealth for shareholders. And this means that almost all the wealth in the world is actually created by companies. I said, okay, I get it. Invest in companies, buy stocks. But what about real estate? Because like many Europeans, I had always heard that real estate was the most reliable way to invest. And my mentor asked me, well, do you know anybody who owns real estate? How much time do they spend looking for tenants, answering the phone, fixing toilets, dealing with people who won't pay, and all that? I said, but it's profitable, right? He said, sure. That's because as a real estate investor, you are basically running a one-person company. You buy a house or apartment, and that's your primary business asset. Then you find clients, your tenants, and you sell them a service. And then you've got to keep your clients happy long-term while keeping costs low. Real estate can be a really profitable business, but as the business owner, you need to do all the work. With the stock market, you can invest in hundreds of businesses like Apple or Microsoft or Coca-Cola, and these businesses, they are run by other people. They do all the work. Does that make sense? To me, this was an incredibly helpful conversation because it really helped me understand why stock investing has been so powerful at building wealth over the centuries, and why it's kind of the obvious choice for busy people who don't have a lot of time to spend investing or building their own business. This does lead to a couple of obvious questions. First, how exactly do you make money with stock investing? And second, how much money can you make? Now, the first question is relatively straightforward because remember, with stocks, we are investing in companies. Let's say you have a small business selling lemonade on a street corner. There are two ways you can make money. Here's the first way. You buy some lemons for cheap, you make lemonade, you sell it more expensively, and you make a profit. Then you take that profit out of the company. That's what we call a dividend. Second, you hope the company is successful, so the stock price goes up and you can sell it at a profit. In technical terms, we call these two sources of profit dividends and capital gains. Now for the second question. How much money can you make from stocks? We have all heard about a few outlier stocks like Nvidia or Tesla, where you only needed to invest a modest amount to become a millionaire 10 or 20 years later. But what are more typical results if you don't get lucky enough to pick such amazing stocks? Well, developed world stocks in general, so that's countries like the USA, Canada, Germany, the UK, they have earned an average of 9% per year over the past 50 years. To a beginning investor, this can seem a little bit disappointing. For example, when I was starting out 17 years ago, I had $10,000 in my bank account, and 9% of that is just $900. Not a life-changing amount, right? So in the beginning, I wasn't even sure that it was worth investing at all. But in fact, 9% per year is a tremendous profit level. It is just really hard for us to understand it, and here's why. So back in our caveman days, if you were picking berries, in one day, maybe you could pick 3 baskets. In 2 days, you could pick 6 baskets, and in 10 days, you could pick 30 baskets of berries. That's it. Your output went up linearly with time. But stock investing is different. Let's say you start with 10,000 euros and you make 9%. The first year, your profit is 900 euros. But the next year, you're making 9% not of 10,000, but of 10,900, so your profit is bigger. And the next year, you're making 9% of 11,881, so your profit is bigger again. It's not linear. Your profit grows geometrically, and our caveman brains don't really understand that. Suddenly, 20 years down the line, you've got 56,000 euros in your account, almost 6 times more. This is how stock investing has created tremendous wealth for investors. Because think about it. You work for a whole year and you save 10,000 euros. You could leave this money in the bank and still have 10,000 euros plus or minus in 20 years. Or you could invest this money, and in 20 years you would have 50 or 60,000 euros available for spending. I mean, that would make a huge difference to your future wealth, right? That said, there's still the elephant in the room. What about risk? Sure, some stocks like Apple or Microsoft have made investors tremendously rich. But you have also heard about stocks like Enron, Lehman Brothers, Blockbuster, Bed Bath & Beyond. These are companies that went all the way to zero. People lost all their investments. When Professor Henrik Bessembinder analyzed 26,000 stocks in the US market over the past 90 years, he discovered that around 11% were total losses. Investors lost all the money they put into these stocks. And the bad news doesn't really end there. Here's a statistic that surprises even most investment professionals. More than 50% of all stocks in the market lost investors at least a bit of money. That's right, half of all the stocks in the market were unprofitable for investors. How is that possible? The stock market as a whole has been tremendously profitable, but the average stock lost you money? Well, it's because most of the profit in the market came from just a few really profitable stocks. In fact, just 83 stocks out of 26,000 over those 90 years gave you half the profits in the US stock market. So basically, to make good money, you had to be tremendously smart or tremendously lucky and find these profitable stocks. Clearly, picking individual stocks is an incredibly risky way to invest in the market. If you pick just 3 or 4 or 5 different stocks to include in your portfolio, there is a big chance that you will lose your money. Now, you might be thinking, well, of course, I'm not going to buy bad stocks or average stocks. I'm not going to invest in weak companies that don't perform. I will pick the best stocks and I will get great results. When you're a beginner investor, it's easy to feel like you can predict which stocks will do great. We look at success stories like Amazon, Facebook, Google, and we think, well, obviously, 10 or 20 years ago, I would have known that these companies were going to be huge. These are the stocks I would have bought. But here's why that is hard. Imagine that you want to make money betting on Formula One. So you do all your research, you look at the statistics, you read expert opinions, and you decide. Based on the latest data, Oscar Piastri is the most likely to win the championship this year. As long as Piastri is ranked number 1, can you make a lot of money betting on him to win? Well, not really, because everybody knows he has the best chance to win, so nobody will offer you great odds. To make serious money, you would have to bet on some underdog, somebody nobody expects to win, who then surprises everybody. And unless you have some special insight into Formula One that nobody else has, that is going to be extremely difficult. And it's similar with stocks. It's not enough to identify companies that are strong or have great future prospects. If everybody already knows that Meta or Google or Nvidia is likely to do great, the stock price will already be high. You will not be able to jump in and make huge, easy profits. To make the real money, you need to identify these great stocks before everybody else. And here's why that is so hard. Unless you have some unique insight into the stock that other investors don't have, how do you do that? It is virtually impossible to get these special insights into stocks because you are actually not legally allowed to trade based on insider information. You can only use information which is available to everybody in the stock market. And that means that you will be competing with millions of investors to analyze the same information. Your competition includes big hedge funds with supercomputers and teams of PhDs. And this is why I don't recommend trying to pick individual stocks for most beginning investors. You will spend a lot of time, a lot of effort, and chances are you will pick the wrong stocks and get bad results. So that's the bad news. But the good news is there's an easy way around this problem. Instead of trying to win the lottery on a few lucky stocks, you build a diversified portfolio of hundreds of different stocks. You basically invest in the whole market. And this kind of diversified portfolio is what would have gotten you that 9% per year result over the past few decades. It's a strategy recommended by Nobel Prize winners as well as legendary investors like Warren Buffett. It's pretty much all I do with my family's money. And it's really simple, very doable even for complete beginners. But before we get to that, there's another half of the risk equation that we haven't even talked about yet. So let's say you invest in a diversified stock portfolio, many different stocks, many different industries, many different regions. You are protected from any single stock going bankrupt. But you still shouldn't expect a smooth escalator ride up where you earn 9% per year every year. The stock market is much more like a roller coaster. So in some years like 2023 and 2024, you could make as much as 26 and 25%. And in other years like 2008, you could lose as much as 38.5%. And just like on a roller coaster, if you want to have a good time, you have to stay on the ride. If you freak out and jump off in the middle, well, that ends exactly how you'd expect. To stay calm at such difficult moments, you need to understand the relationship between risk and time in the market. So there are some activities in life where the longer you do them, the riskier they get. Take the casino, for example. Let's say you play the roulette one time. If you bet on the colors, either red or black, you've got roughly a 48% chance of winning versus losing. But if you play the roulette 1,000 times in a row, well, that negative 2% edge really adds up, and you are virtually guaranteed to lose a lot of your money. The longer you play, the bigger your risk. Now, luckily, with stock investing, it's the exact opposite. If you look at the last 50 years of market data, if you picked a random date and invested in stocks for 12 months, that would have been a little bit risky. 75% of the time, 3 out of 4 years, you would have made money. But 25% of the time, so that's about 1 out of every 4 years, you would have lost money. Now, hopefully it makes sense that if you got a game where 75% of the time you win and 25% of the time you lose, then you should play it again and again and again, right? And the data confirms that this is smart. If you invested in stocks for a random 5-year period over the past 50 years, you actually had an 88% chance of being profitable. If you invested for a 10-year period, you virtually always made a profit. So the lesson is that the longer your time horizon, the less risky stock investing becomes. And when you think about it, that makes sense. Remember that investing in stocks means investing in companies. And if you give companies enough time to work hard and solve problems, they can recover from pretty much any crash or crisis. All you need to do is avoid getting scared when the market drops and stay invested. Now, there are some ways to reduce your investment risk even more. I cover some of them in a more advanced training that I've linked in the video description. But for now, let's move on to the next question. So, we already decided that buying individual stocks is risky, and we need a portfolio of many different stocks. But what is the best way to create such a diversified portfolio? Well, for a small investor, the only practical solution is buying an investment fund. Investment funds come in 2 different flavors, active and passive. Active funds are the more traditional approach. You give your money to a fund manager who tries to pick the most profitable stocks and attempts to guess optimal times to buy and sell those stocks with your money. Unfortunately, most active funds are quite expensive. You pay a lot in fees. And research shows that the vast majority of these fund managers who try to invest your money, well, they just don't have enough skill to justify the high fees that they charge you. In fact, according to this paper from Standard & Poor's, even when active funds do get you a better result, it is usually just because of luck, not because of skill. And that makes it really, really difficult to choose an active fund which is likely to give you great results. Basically, you're just gambling. Sometimes you get lucky, sometimes you don't. On average, active funds will get you something close to the average profit of all the stocks in the market. In other words, the market average return, minus a big fat fee. And frankly, that's just not a great result. So what should you do instead? Well, the answer is quite simple. You buy index funds and ETFs. These are so-called passive investment funds pioneered 50 years ago by Jack Bogle in America. A passive fund recognizes that picking the best stocks is virtually impossible ahead of time. Instead of trying to guess the winning lottery number, it buys the whole lottery. Instead of trying to pick winning stocks, they buy a little bit of every stock in the market. And because this is really easy to do, it can be done with very low cost. Remember, the typical active fund gets you the market average result minus a big fat fee. A passive fund gets you that same market average result minus a small fee. So which do you prefer? The famous research firm Morningstar does a study every year called the Active-Passive Barometer. They compare two scenarios. One, you trust your money to an active fund managed by a professional investor. Or two, you simply put your money into an index fund or ETF. And over the past 20 years, when they looked at funds investing in American stocks, passive funds beat active funds 90% of the time. Think about that for a moment. If you're a busy person, if you don't have a finance background, you don't want to spend 40 hours a week on investing, isn't it crazy that you can just buy a simple index fund or ETF and get top 10% investment results? And the best part is, passive investing takes literally just a few hours per year. This is why, for most people, index funds and ETFs are the obvious, no-brainer way to do stock investing. To be sure, there are some challenges with this in Europe. Getting started can be tricky because you have to answer questions like, how do you choose the right funds to buy, taking into account your goals, your age, your risk tolerance? Which investment app do you trust with your savings? What taxes do you need to pay? And other details. I have a step-by-step training on all these topics, so you can just follow the link in the description if you want to find out more. But for now, let's do a practical demonstration. First, I will show you how to buy an individual stock, and then I will demonstrate how to buy a passive stock fund, an ETF, with just a few clicks. Now, the first challenge is that we can't just buy a stock directly from the company itself. If you go to the Tesla website, you can't find a button anywhere that says buy the stock. Okay? Stocks are traded on stock exchanges, but you also can't buy a stock directly from the stock exchange. For example, Tesla is listed on the Nasdaq stock exchange, but when I go to the Nasdaq website, there's also no buy shares button. We need an intermediary which connects regular investors to the stock exchange. And this kind of intermediary is called a brokerage. Think of a brokerage like a supermarket for investments. For this demo, I'm going to use a brokerage called Trading 212, just because they have a great user interface, so this is a brokerage I often use for demonstration. But keep in mind that this brokerage may not be the best choice for your individual situation, especially if you live in a country like Germany or Austria or Denmark, where using local brokerages is best for taxes. When you log into Trading 212, you see a lot of information like the most traded stocks, you see top winners, you see top losers. But here's a pro tip. That is all short-term information. It's just noise. You can just ignore it. I'm going to assume that you already did your research and you decided to invest in Airbus stock. Now, this is not a recommendation. I personally don't hold any Airbus stock in my portfolio. I'm just using it as a simple example. Okay, so if I want to buy Airbus stock, I would look it up here in the search box. I can actually buy it on different stock exchanges. I can buy it on the Paris Stock Exchange or on the Frankfurt Stock Exchange. I'm going to go with Frankfurt in this case, and I will click buy and buy one share. Now, when I teach my full investment training courses, I usually recommend using a limit order. This allows you to get the best possible price. But for simplicity of this demonstration, I will use a market order. So that means I simply tell the brokerage, get me one share of the stock at the latest price. Okay, so I'm going to hit review order. That looks good. And I hit send buy order. Instantly, I bought one share of Airbus at 158 euros and 46 cents. Okay, so it's as simple as that. But like we discussed before, for most people, buying individual stocks is probably not the best choice. So instead, we want to buy passive funds, index funds or ETFs. And in most European countries, the type of passive fund that is easiest to buy is an ETF, an exchange traded fund. To find the best ETFs, you can use a website called justetf.com. It's got around 3,000 different ETFs that we can buy from Europe. For this particular demonstration, I will simply pick the biggest fund by size, which is the iShares Core S&P 500 UCITS ETF. So this is an ETF that invests in 500 of the biggest American companies. Again, not an investment recommendation. This is not actually what I use for my own portfolio, but I will simply use this to do a demonstration. So the way I would do it is I would look at this fund, I would copy the ISIN. This is a unique identifier which identifies an ETF. And I would go to the brokerage and put it in the search bar. And this brings up the ETF. I can buy it on the London Stock Exchange in pounds. I can buy it on the Frankfurt Stock Exchange in euros. And again, on the London Stock Exchange in dollars. Well, I live in the Eurozone, so let me pick Frankfurt. I see the price of this ETF is 557 euros. I don't really want to invest that much in this ETF at the time, but the good news is that today we can buy what are called fractional shares. So this allows us to invest small amounts of money. Not all brokerages offer this, but Trading 212 does. Okay, so I will tell Trading 212 I actually want to buy 0.1 shares. That's around 56 euros of this ETF. I hit review order. I look everything over, looks good to me. I hit send buy order. And within seconds, I bought 0.1 shares of this ETF at a price of 557 euros and 64 cents. Even if you don't have a background in finance, even if you don't have a lot of money, you can buy one of these index funds or ETFs. It takes you just a few hours per year, and that's all you need to grow your money over time. The only challenging part here in Europe is getting started. Which specific ETFs or index funds should you choose given your goals and how much risk you're willing to take? What brokerage is best for you and how do you handle taxes in your country? If that sounds interesting, you will want to check out the in-depth training on ETFs and index investing that I've put together. Check out the video in the description below.